Hello and welcome to valuation of Barrick gold. This is the full version posted only for the gold members on my website, that's myfinancesteacher.org. The video is recorded on the 8th of April. So in this video we're going to talk about valuation for Barrick gold and compare that valuation to the current market price to determine whether the stock is under or overvalued. In my valuation model, I use several factors, including gold price, and we're going to look at three different scenarios: conservative, balanced, and an optimistic scenario involving three different gold price levels. We're going to look at the reserves of Barrick gold, both proven and probable, as well as measured and indicated, and the use of this information on different types of reserves will also be different from conservative to balanced and optimistic valuations. Clearly, to mine the reserves out of the ground, the company needs to incur some costs, so we are going to look at production costs. The value of the reserves underground to the investors are diminished by the debts that the company has, so we also take into account the company's long-term debts. The number of shares outstanding clearly influences the value of the company per share. Mining the reserves out of the ground will take time. It's not immediately that the investors receive all of the value of the reserves after production costs and after company debts. At given annual production, there will be a number of years that it will take to mine the existing reserves. This number of years affects our discounted value per share. And we also take into account how many insider investors are there. As they're likely to be smart money with possible insider information, they're also likely to hold the shares tightly, reducing the available float on the market, which also might support the share price. Moving on to gold price, as I mentioned, we're going to look at three scenarios: conservative, balanced, and optimistic. And even the balanced scenario is leaning more towards conservative because the price I'm going to use for the balanced scenario is $1,550, which is $100 below the current gold price at the moment. The price for the conservative scenario is 10% below the price of the balanced scenario, which is $1,395. And the price in the optimistic scenario is 10% above the price in the balanced scenario, which is $1,705. Looking at the annual reports of Barrick Gold, we see that the company has 71 million ounces in proven and probable reserves. They also have measured and indicated gold reserves of 99 million ounces. We will use these reserves in our optimistic scenario, whereas for the conservative and balanced scenario, we're actually going to throw this number away completely, reducing our risk of buying an overvalued share. So as I noted earlier, our balanced scenario is already leaning more towards conservative, trying to reduce the risks of our investments. The company also has silver proven and probable reserves of 150 million ounces, and Barrick Gold also has copper proven and probable reserves of 13 billion pounds. Unfortunately, the price of copper on the market at the moment is below the company's all-in sustaining costs of producing that copper, so these copper reserves are not going to add much to the company valuation. This is the chart of changes in Barrick's proven and probable reserves of gold. As we see, compared to last year, these reserves increased by 9 million ounces. Looking at costs, the company's projections for 2020 are such that all-in sustaining costs for gold are somewhere between $920 and $970 per ounce. In my model, I'm going to use $940 per ounce. In the valuation of the company's silver reserves, I'm not actually going to look at the cost of producing silver. Instead, I'm just going to convert silver into gold equivalent, so to speak. And I'm going to use a gold-silver ratio of 100. In either case, the value of silver reserves are very small compared to the total value of gold reserves that the company has. So whichever way we take into account the value of silver reserves is not going to change our model's valuation that much. And last year's all-in sustaining costs of producing copper were $2.52 per pound. Unfortunately, right now, as I mentioned, the market price of copper is below that price. Next, looking at company's long-term debts. From the balance sheet, we see that the company has over $5 billion in long-term debts. More specifically, $5,161 million. All of the company value, of course, will have to be divided by the number of shares outstanding, which is 1.78 billion shares outstanding. And only 0.09% of those shares are held by insiders. As I mentioned earlier, it will take time to mine the reserves out of the ground. There are substantial reserves, and annual production is 5.5 million ounces per year of gold. For the time value of money, I'm only going to use a discount rate of 2%, as this is not fiat money that we are discounting. This is the actual value of gold reserves in the ground that we are discounting. If it was fiat money, future cash flows that we were discounting, we would probably have to use a much larger discount factor here, especially with the recent trillions and trillions being printed by the central banks, meaning that possible likely inflation in the future should be taken into account with a larger discount rate. But again, we are talking about the actual gold reserves in the ground in this case. So I think a 2% discount rate is very reasonable. Look at it as the cost of waiting for that hard asset, which is gold. If you were to borrow, let's say, some hard asset such as gold, would you be happy enough to pay a rate of, say, 2% per year? If yes, then I think this rate is more or less appropriate. If not, if you think this rate would be too expensive to pay for you as a borrower of a hard asset, which can't be inflated out of thin air, then we should probably reduce this discount rate, meaning that the actual model valuation is going to increase, in which case the effect of actually using a 2% discount rate is that the risks of buying an overvalued share decreases. So now we combine all of this information. Much of this I've mentioned earlier. Gold price that we're going to use is $13.95. Reserves in years, that's the total proven and probable reserves of gold divided by annual production of gold. Reserves in years is 13 years. The rest of the information I have mentioned earlier, and all of that gives us a conservative valuation of $13.66. That's without including the value of copper, as the price is smaller than all-in sustaining costs. And if we were to, let's say, assume a future copper price of $2.7 per pound, that would give us a valuation for a company share of $14.8, which is still significantly lower than the current market price of $20.31. Meaning that if we were to see a substantial drop in gold price all the way from $16.50 down to under $1400, then we would likely see the price of Barrick gold drop quite a lot as well. But whether you think a drop in gold of more than $250 is very likely or not, that is a different question. That's why this is our conservative valuation. Next, looking at balanced valuation, all the information is the same as in the conservative valuation except for the gold price. We are using the price of $100 below the current market price at spot. And all of that gives us a valuation of $19.18. And including copper at the hypothetical price of $2.7 would give us a market valuation of $20.32, which is pretty close to the current market price. So I would say the company is relatively fairly priced at the moment. And in the optimistic scenario, again, we are using much of the same information except for two changes. We are going to use the gold price of $17.05, which is only $55 above the current spot price. And we're going to include the measured and indicated gold reserves of the company, but not all of that. As measured and indicated reserves are less certain compared to proven and probable reserves, we're going to only include half of the measured and indicated resources of the company, which would be around 49 million ounces. Again, by including only half of those measured and indicated resources, we're reducing our risk of buying into an overvalued company. And yes, I know that recently there have been changes in the way they report measured and indicated resources. Last year, these did not include proven and probable reserves. This year, the resources include the reserves as well. The number I'm showing over here does not include the reserves, so this number is comparable to the numbers reported in previous years. And again, we're only using half of those measured and indicated resources. All of this gives us a valuation of $39.67 without copper, and if the price of copper were to rise to $2.7 per pound, that would give us a valuation of $40.81, which I think is a pretty nice potential gain over the current market price of $20.31. And again, whether you think that an increase of $55 in gold price is likely over the coming future or not, that is a separate question. Next, let's have a quick look at the chart. This chart compares the price of Barrick gold to the price of gold itself. Blue line is Barrick gold, purple line is gold itself. We see that clearly Barrick gold is correlated with the gold price. An increase in gold price, of course, pushes the price of this company's share higher. And the volatility is higher in the share price compared to the gold price. Since last summer, gold gained nearly 27%, whereas Barrick gold gained nearly 65%. However, if an investor were to buy an overvalued share somewhere at the peak, the drops would be more significant than the drops in gold price as well. The potential for good returns is higher, but the risks are higher as well. And lastly, looking at the daily chart with some more indicators, it looks like less than a month ago, the share price has started rising from under the Bollinger Bands back towards the top of the Bollinger Bands. Since the share price follows the gold price, I think it might follow the half-a-year gold cycle. So looking at what happened in the last two gold cycles, we see that from August into October, the share price of Barrick gold only topped when the 14-day RSI was into overbought territory. And that happened after the price poked several times through the upper range of the Bollinger Bands. Same thing happened here between May and September last year. By the time the price topped, RSI was deep into overbought territory, and we saw multiple pokes through the upper range of the Bollinger Bands. Same thing here again from November to February this year. Multiple pokes through the Bollinger Bands and RSI into overbought territory. What's happening at the moment is we haven't had any pokes through the upper range of the Bollinger Bands yet, and the RSI is only at 58. So in my opinion, I think there is still some potential for Barrick to follow gold higher, possibly over the next couple of months. So there's my valuation for Barrick gold. Let me know what you think about this company in the comments to this post on the membership site. I will read each and every comment in my gold members area. Have a nice day and good luck in your trades.